Welcome everyone and happy new year and welcome again to this Lamb's Cryptoverse. So today we're going to do something different because I love to do different stuff. So as you know, the last few months I've been focusing on the data, the CPI, BPI, and labor report, things like that. But today I'm going to focus on only one thing, the effect of the recent labor report and the recent report from the ISM on business. And so let's just summarize some of the data for those of you that don't know what happened. So today, the Bureau of Labor Statistics came out with their employment situation report for December 2022. And they said, and it's marked in red here, that total non-farm payroll increased by 223,000 in December. And if you go lower here from the household survey data, the unemployment rate edged down to a really, really low 3.5% in December. And then they mentioned, this goes on and on for pages, but they mentioned that it's been in a narrow range. So it went down, it was very high during COVID, and then it went down very low to historically low levels, and it stayed there. So these two sentences, I just want to focus on these two sentences I just read to you. These two allude that the Fed's going to be very hawkish. However, something else came out within that report, and then there was another report that came out. Within this report, we have this, and this is a little crude, but I'll read it to you. It says in December, average hourly earnings for all employees or on private non-farm payrolls rose by 9 cents. So what they're saying is that wages rose 0.3%, so that's less than expected. And then if they talk about when they talk about private sector workers, they've rose even less. And they also mentioned the year-over-year data. If you read this sentence, they said the year-over-year data was growth was 4.6%. So basically, this is good. This is showing that wages are coming down from their peak, and it could even be because of employee and employer perceptions. Believe it or not, perceptions are a very, very strong forecaster of what inflation could be, because everyone's watching the news and you're hearing about all these tech layoffs, and that's scaring people. It's even scaring employers. They think, oh boy, there's a tidal wave of weak economic growth coming, and employees are getting scared because they're thinking, oh my God, I better take any job at any price and any salary. But what they don't know is that the tech industry, even though there's a lot of workers, for example, Amazon just said they would lay off 18,000. So even though the tech industry is laying off workers aggressively, that industry is still small. So, but nonetheless, the effect is still there. Wages are growing slowly. So this report overall should have been hawkish, and treasuries should have declined, meaning rates should have gone up, and the stock market should have gone down. But this is what happened today. Soon thereafter, the ISM Services Index came out. And this is actually, before we talk about that, this is just showing the number of jobs created and that and the number of layoffs. And you can see the information industry tech sector shows up here, as I was just talking about earlier. But let's go back to ISM Services. So we got two reports from the Institute of Supply Management. And don't get this report mixed up. There's other reports like the Flash report, the S&P report. These are global PMIS on ISM reports. These reports are different from this. This report from the Institute for Supply Management, this report goes back many years, as well as the one for manufacturing. So we've got two. So the one that most people know about is this one. This is the PMI manufacturing report. And this is the one I've been saying would decline and has been declining. But I said I thought it would be lower. This is what you call soft economic data. But the big surprise here and what I've been waiting for is this report that came out today. This is the services report, and it just dived. And I'm going to show you this table here, services at a glance. And I'm going to zoom in there so you could see it better. So you can see the services in PMI index. This is the top level report that you see Bloomberg and CNBC reporting on. This index died from 56.5 to 49.6. That is below 50, and that's the first time that's happened since May 2020. So this is a very significant indicator. And you could also see there was a big decline in business activity of 10 points, and in new orders of 10.8 points, and in supply deliveries, and even in prices. And I mentioned this in my previous video. The problem is, I kept saying, is that the services industry, which is 2/3 of the US economy, is still strong. And that's why wages are not budging. That's why wages are sticky. But finally, we're seeing the beginning of a weakness in the services economy. And you're seeing some decline, not enough yet, some decline in the prices index. And I think that's everything else. There was one surprise for me, and that was new export orders. They showed an increase of 9.3 points. I don't know why that's happening. I didn't look into that because today I want to really focus on the effects of all this news. So again, the labor report at first seemed hawkish, but it's not, because wage growth was better than expected. And number two, the services index dived, which is very good if we're worried about inflation. This will help the Fed become less hawkish. So let's go to the effects, because that's what I want to talk to you about. The first effect is that stocks rose sharply. You could see the Dow rose 2%, NASDAQ 2.6%, and S&P rose 2.3%. So it was a broad-based rally. And you could see Treasuries also did well. Here, you could see Treasuries did quite well, especially in the long end, and that's what I'm going to focus right now. What I do is I actually input this data myself into an Excel spreadsheet, and you could see this is the table, hopefully you could see it, of all the yield to maturities at different time periods. For the first one I put in is July 14th, 2022, and then I put in today's yield for July 6th. And what you notice is, maybe I should have put titles here, but basically these are the different time periods moving from left to right. And I've got the 10-year, you know what, let me just, let me freeze that so you can see that. So you could see the 10-year minus the 2 years at negative 72 basis points. The 30-year minus 2 year is my minus 60 basis points. But what I want to focus on is a 10-year versus a 3-month. And I put a little formula here. This finds the minimum number. And today we reached that minimum number of over negative 100 basis points, minus 105 basis points, meaning the 3-month yield is higher than a 10-month note by 105 basis points. And another way of showing that is this here. Let me just undo that freeze I did. Let me minimize myself a bit here. So basically, you could see here. Hopefully, you can see it's a little slot. It's a little detailed. Let me just make it better. Now, what you can see here on top, the red line and the green line. You could see the red line is the 1-year bill. I didn't put the 3-month bill, but it's equally as high. And you could see the green one is a 2-year note. So basically, the 1-year note has stayed high. And that's what I've been expecting, and that's what I'm continuing to expect, because the Fed's going to keep raising rates, or at least hold rates high. And that's why you're seeing short-term rates they went up and they stayed at a high level. But if you look at the longer-term rates, and on the bottom here in brown, you've got the 10-year note yield, and then in blue, you've got the 30-year bond. You can see that those rates have declined. And another way of showing this is by looking at the actual yield curve, which I did here on the right side. I may have to minimize it because it's a big chart. And let me just minimize it for you so you guys can see it better. And let me just get rid of that. I froze some panes. It's better if I unfreeze the panes, you can see it better. So now you got to read this from right to left. So on the right side, you got the 1-month bill. And then moving towards the left, you get longer and longer maturities. So at the end here, we got the 30-year bond. Now, here's the most important point. As I mentioned it just before with the table, now I'm going to show you with the chart. You can see so this is showing 2 time periods. It's showing the initial time period that was back in July of 2022, and it's showing today, January 6th, 2023. And it's showing you that the 1-month bill, that rate went up dramatically. But as you move forward into longer and longer maturities, that rate moves up less. And this is how you get an inverted yield curve or a negative yield curve. Because if you look here, the highest rate is at 4.8% for 6 months. But then that rate keeps going down. I mean, it's not going to be perfect. But you can see in this case it was. Actually, I missed one here. This should be moved up. So there we go. That's around the same. That's a 1-year bill. So basically, this is what you call a negative yield curve. And this is what I've been expecting for a while. I said to you a few months ago that my mistake was I thought this was going to happen quicker than it actually happens, but I did not do enough research. If I did my research, I would have known that it takes time for the economy to slow down when the Fed becomes hawkish. And the same thing with stocks. I thought stocks would decline even more, but it takes time, again, for these things to happen. These things move slowly, right? You've got inventories, you've got exports, the dollar affects everything. Everything takes time. And so what I see now is what I was expecting, that my expectations for a negative yield curve and lower long-term rates is happening. So that's a good sign, at least for me, because it's what I thought would happen. The second thing I want to talk to you, or last thing I want to talk to you about, is what's going to happen with stocks and crypto. I still think, because this is a good thing that yields are going down, and because of that, stocks went up. But unfortunately, I think what's going to happen is what I talked about in the previous videos is part 2. I think part 1 of the decline in the stock market was the compression or decrease in the PE ratio. Number 1, I should say part A is I still think that PE ratio could go a bit lower, but the big factor that's going to cause the stock market to go lower and crypto to go lower, because crypto is correlated with stocks, is that the earnings estimates are going to go much lower. If earnings estimates go lower, that's going to cause the E in the PE ratio to go down, and that's why stocks are going to go down. Now, let me just make clear to you all that I am an outsider in this. I'm on left field, I guess. Basically, most analysts and consultants, what they do is they do these bull, bear, and downside case and middle cases. And when they do that, they take the middle number, right, for the economy and the stock market. And what they're saying is there's going to be a soft landing. I don't think so. I think we have a higher probability right now of a hard landing for many reasons, which I talked about earlier. One reason is the quick change in inventory. I think we're going to go from supply bottlenecks, like we saw in semiconductors, and too much, not enough supply of chips, to too much supply of chips and other things and other widgets. That's one reason. And number 2 is there always has been, it will continue to be a big lag between when the Federal Reserve raises rates and tightens liquidity into what happens to the U.S. economy. That's why more recently you've heard Jay Powell talk about maybe doing a wait-and-see approach. And so that he's probably going to raise rates at a slower level, maybe not 75 basis points or even 50 basis points, but maybe he'll just raise rates 25 basis points. But he's also talking about raising and holding those rates because he wants to see how the economy is affected by all the front-loaded increases and raises that he's done so far, and there's been a lot. Well, thank you all for listening to Lem's Cryptoverse, and don't forget to like us, and please come again. And one more thing, don't forget to put what you'd like to see from this channel in the comments below.